Thanks for checking out this question from our daily live Zoom calls. Please like and subscribe to keep learning how we help the largest online community of self-directed retirement investors and entrepreneurs grow and control their retirement funds.
Okay, so here the question is, I have money in the pre-tax and after-tax Roth plan. Roth 401k plan. Can I draw funds from each to cumulatively purchase, finance a property? If I have $50,000 in the pre-tax account and $25,000 in the after-tax Roth account, can I draw from each to purchase or finance a property under the plan? My wife is on the plan also. Can I draw from hers and mine to purchase one property? So that's a great question. Thank you so much for bringing it. It's a common question because our plan does allow for Roth, for Mega Backdoor Roth. It does allow for investing in alternative investments like real estate. If you can have multiple people, for example, two spouses who are both working in the same business, participate in the plan. So the short answer is yes, it's possible to do that. To use both pre-tax and Roth money from your account to invest in the same property, or even combining, say, money from multiple participants in the same solo 401k, like a husband and wife, to both invest in the same property. So let's build up to it though. Let's dig a little deeper. So number one, of course, you have to be eligible to set up a solo 401k, meaning you're self-employed with no full-time non-owner, non-spouse, W-2 employees working for any business that you own or that's owned by a spouse. That will allow you to set up a solo 401k. And then our plan, it allows for investing in real estate. It allows for making Roth contributions or after-tax contributions. So let's first talk about the contributions and how you might have different types of money. So our plan, again, allows for pre-tax contributions, right? That could be a pre-tax employee, could be a pre-tax employer. It could also be money that you rolled over from the pre-existing pre-tax account. It also allows for Roth contributions as well as after-tax contributions. So Roth contributions would be typically made as an employee contribution, and the limit is the employee limit. So for example, for 2023, that's $22,500. But in addition to that, our plan allows for after-tax contributions. And that's how one is able to make Mega Backdoor Roth contributions. So if you're making after-tax contributions, those need to be deposited to a separate after-tax account before they're moved over to the Roth account. So here I'm assuming we're talking about money that's really in a Roth account as opposed to an after-tax account. Because if you're investing directly from that truly after-tax, meaning non-Roth after-tax account, any subsequent gains are going to be taxable. So that's why folks move the money from the after-tax account to the Roth, hence the Mega Backdoor Roth name that's used on that type of contribution. So let's assume again that you have money both in a pre-tax and in a Roth. And now let's assume you want to invest in real estate. So that means you have to consider the solo 401k real estate investing rules. So our plan does allow for investing in real estate, but it cannot be a prohibited transaction. So in simple terms, that means that the solo 401k owner cannot be on both sides of the transaction. In other words, one cannot use their solo 401k funds to buy real estate that's owned by that person, or even that's owned by a related person, like a spouse or a parent, or maybe a business or an entity that's owned by the solo 401k owner or participant. So assuming that that threshold issue is satisfied, and the property is being purchased from an unrelated person, then the solo 401k could invest in that property. So that means that the title would transfer from the seller, the unrelated seller, to the solo 401k. And if one wants to use both pre-tax and Roth money, that's fine. So you would have one transfer come from the pre-tax solo 401k account to the seller, say of $50,000, and then the other transfer come from the Roth solo 401k sub account to the seller. Now, let's assume it's a rental property. So really there's just going to be one owner, which is the solo 401k. And for administrative ease, those rent checks can go into one sub account, say the pre-tax account, and then be allocated between the pre-tax and the Roth account at the plan level. In other words, the tenant is not going to write two checks, one to the pre-tax account and the second to the Roth. It's just going to be one check to the solo 401k that gets deposited, say, into the pre-tax account. And then the funds are allocated based on the ratio, right? Based on the ownership ratio between the pre-tax account and the Roth account. Those subsequent gains as well as the expenses are allocated between those two sub accounts. Likewise, if someone has, say, a husband and wife and they want to pool their money together to make a particular investment, right? Really, it's just one entity, the solo 401k, buying the property. The funds would come to make the purchase from each of the two sub accounts, right? One solo 401k sub account for the benefit of the husband, the other solo 401k sub account for the benefit of the wife. And then for administrative ease, the income and expenses could go in and out of one of the two sub accounts. They would just need to allocate the, based on the net income and expenses between the two sub accounts based on the investment ratios, the ownership ratios. So if 2/3 of the money came from the husband's account and 1/3 came from the wife's account, you would need to allocate between those accounts at the plan level. So hopefully that makes sense. And then you mentioned finance. So it is possible to invest, to use debt to make an investment in real estate using solo 401k funds, provided that the property is purchased using non-recourse debt. So that means that the only recourse of the lender is to go after the property itself. In other words, the solo 401k owner or participant is not able to personally guarantee that loan. The only recourse is the property itself. So typically, that means that you can't just go to a standard bank to obtain a loan that's going to be made to your solo 401k. There are specialty non-recourse lenders that will lend to individuals' retirement accounts. But because it's a non-recourse loan, typically those lenders will want 50% down, right? They may want a higher interest rate or a shorter term to account for the fact that their only recourse, again, is the property itself. So hopefully that sheds light and gives you some information on some of the important considerations. Thank you for bringing the good question.